In this video, we're going to be looking at shares. Buying shares in a publicly listed company is another way to invest money. To expand business, companies require substantial amount of capital or money. And to raise these funds, a company can sell shares in the company to the public, as long as the company is publicly listed. That is, that it's actually listed on the stock exchange. For example, in Australia, for a company to become publicly listed, it must comply with the standards set by the Australian Securities Exchange, or ASX. Purchasing shares in a company means you are purchasing part of that company and will potentially share in the company's profits as well as its losses. Buying and selling shares is usually done through a stockbroker, who can provide valuable advice about the company. A brokerage fee applies for share transactions. This fee will vary depending on the broker. As with all investments, it's important to be well informed before investing. The brokerage fee is added to the total costs when buying shares and is then also subtracted from the total costs when selling shares. So we're going to go through an example where this can be affecting the actual total cost of the shares. To be able to calculate this, we're going to use this formula here, where the total cost equals market price plus the brokerage. To calculate the market price, we have to actually multiply the cost of each share by the number of shares purchased. And to calculate the brokerage, we have to actually multiply the brokerage fee by the market price. Let's go through an example now. It says Margaret bought 2,000 XYZ shares at $7.40 each. What did it cost her to purchase them if the brokerage fee was 0.31%? So the first thing we're going to do is we're going to calculate the market price, and that is by multiplying the cost of each share by the number of shares that she bought, which was 2,000. So if we multiply those two together, the market price for the total amount of shares that she bought is 14,800. We're now going to calculate the brokerage, and the brokerage is calculated by the percentage rate, so 0.31, and multiply that by the market price, which was 14,800. And when that's calculated, the brokerage is $45.88. So now what we're going to do is we're going to use these two values to find the total cost, which is the market price, which was 14,800, plus the brokerage, which was $45.88. So if we add these together, the total cost, including the brokerage fee, was $14,845.88 for the shares that she purchased. We can also calculate the money received, and we can calculate that by using this formula. So money received equals market price minus the brokerage. So we're calculating the same two amounts, but this time we're subtracting them, and that's how much money a person will get back once they sell the shares. So the example says, if the brokerage fee was 0.24%, how much money would be received from the sale of 800 bank shares at $24.50 each? So remember, the market price is calculated by calculating the price, so $24.50, by the number of shares, which was 800. So if we multiply both of those, we should get 19,600. The brokerage is by multiplying the percentage rate, so 0.24, by the market price, which was 19,600. And from that, we should get $47.04. So the money received is to actually subtract these two amounts. So first the market price, which was 19,600, subtract the brokerage, which was $47.04, and that should give us a total of money received of $19,552.96. So once selling those shares, that's how much money is received after brokerage. We can also look at dividends. If a profit is made by the company distributes some of the profits to the shareholders, and this is called a dividend. The dividend is usually quoted as cents per share, and it is calculated by dividing the after-tax profit by the number of shares. Let's look at an example. It says a company has an after-tax profit of $34.2 million. There are 90 million shares in the company. What dividend will the company declare if all profits are distributed to the shareholders? So what we're going to look at is trying to calculate the dividend per share. So we're going to use this formula here. So the profit was $34.2 million. So 342 and then 1, 2, 3, 4, 5 zeros divided by the number of shares, which was 90 million. So 90 and then 6 zeros. 1, 2, 3, 4, 5, 6 zeros. So if we divide these two amounts, we should get 0.38. So that tells me that the dividend is 38 cents per share. We can also calculate a dividend yield. So the price of the share traded on the stock market is known as the market price, and this price will vary depending on the market. The dividend yield calculates the percentage return on the money invested. If the money was invested in a bank, this percentage return on the money would be the interest rate on the deposit. And we calculate that by using this formula. And also remember that the market price is the price of the share traded on the stock market. So let's go through an example where we use this formula. So it says a company with a share price of $5.85 declares a dividend of 32 cents per share. Calculate the dividend yield for this company. So what we're trying to do is calculate the percentage dividend. So what we're going to do is use this formula. So the dividend per share, as seen in this question, was 32. And the market price was $5.85. Now we want both of these values to be the same units. So if I've done 32 cents, I want this in cents as well, so 585. And we're going to multiply it by 100 because we want a percentage rate. So if we calculated this, we should get 5.47%. So the dividend yield for this company is 5.4%. The price-earnings ratio is another way of comparing shares. The ratio gives an indication of how much investors are prepared to pay per dollar of earnings or annual profit. It gives investors a sense of how profitable the company is. The price-earning ratio can be interpreted as the number of years it will take the company to pay back the amount investors paid for the original shares, assuming the company doesn't grow or shrink and its current level of earnings remains constant. And we can calculate the price-earning ratio by using this formula, where we divide market price and the earnings of the company. So let's look at an example. Paul bought 100 Cottonworth shares at $5.75 per share. The company paid a yearly dividend of 19.5 cents per share. And we're going to assume that this is all profits. The first thing that we're going to do is calculate the total dividends received. So the first one is we're going to do the total dividend equals divide dividend per share times the number of shares. So we can see here that the dividend per share is 19.5, and we're going to multiply that by the number of shares, which is 1,000. So that will give us a total dividend of $195. The second thing we're going to now do is calculate the dividend yield. And we're going to do that by dividing the dividend per share, just like we did before, which was 19.5 cents, divided by the market price per share, which was 5.75, so $5.75. Remember, they've got to be in the same units, and we're going to multiply that by 100. So that's going to equal 3.39%. And the last thing we're now going to do is find our price earning ratio, which is the market price per share, which was $5.75, divided by the yearly profit per share, which was 19.5 cents. So if we calculated that, we should get 29.5, and that is our profit earnings ratio. So it's important with all the different calculations for shares that you use the correct formulas. And to be able to know that, it's really important to look at each question and take out each important component, or really read into what the question is telling you. Once you do that, make sure the units are correct and then calculate accordingly. The last thing you'll need to make sure is that the final answer has the correct units, whether it's dollars or it's percentages.